Never been a fan personally of bridge loans, which is a short-term loan to get you from A to B, get you a quick close or whatever, so you can kind of get in there, renovate, and refinance. Well, this is not.
Welcome to The Path to Wealth, the show about well-being, fulfillment, and financial freedom. And I'm your host, Hannes Henchen. Welcome back to The Path to Wealth. Today's discussion is going to be a great one. I'm joined by my guest, Travis Watts, who has been an investor in multifamily apartments for over 13 years. He's the host of the Passive Investor Tips with Joe Fairless, speaker and director of investor education at Ashcraft Capital. If you're new to this show, welcome. If you're a long-time listener, thank you for coming back. We're glad to have you here. Today we'll be talking about multifamily apartment investing, how it works, what it takes to succeed at it, and why it can be such a quick way to build wealth. We also talk about Travis' experience as an investor in multifamily apartments and his dedication to educate people about passive investing. Welcome to the show, Travis.
Hannes, thanks so much for having me, man. Thrilled to be here.
Yeah, so let's dive right in. How did you turn to real estate? I know you've been also looking at Wall Street. You have the series, and you also went to overseas working in oil and gas. But when did you turn your attention to real estate, and why did you maybe focus on that over other investment possibilities?
That's a great question. So I had the seed planted pretty early that I wanted to get involved with real estate. We've all kind of gone through the books of the Rich Dad, Poor Dad series and stuff like that. And so I read those all the way back from high school years. So obviously not in a place financially at that point in my life to dive into multifamily apartments, but planting the seed of passive income. Why passive income? See, very few people teach that concept because Wall Street is all built around buy low and sell high, right? Max out your IRAs and your 401ks. And then when you're 65, hopefully you have enough of a nest egg saved up to, withdraw from. So I got really interested in this concept of finding assets that produce monthly passive income, specifically monthly. And it turns out there's a lot of them. And I never knew that from an early age. But multifamily was kind of my ultimate bread and butter because it was an asset that can give you monthly cash flow, potential equity upside, meaning buy low, sell high, like most of us were taught to invest, extreme tax advantages that are very lucrative, and the ability to use leverage, the ability to go to a bank and obtain a loan to where you can maximize your cash flow yields. And after diving into single family homes for a while and doing fix and flips and doing vacation rentals, that's how I started the first 6.5 years. There was a couple gentlemen that I was introduced to through a real estate meetup group. These guys had sold their businesses in the mid 1990s and kind of overnight had to become investors because they came into a windfall of money and they had to go do something with it. And so that became their full-time focus at that point. They just became full-time passive investors. And I thought that was the coolest thing to meet somebody in person, in my own city who was willing to kind of mentor me of sorts, and explain what a real estate private placement is and explain how, the money I was putting into single family homes, I could be putting in less money and then partnering in a 500 unit apartment building. And I just thought that was the coolest concept for me. And so in 2015 and 2016, I started to transition my portfolio from single family and kind of the buy low, sell high stuff into full-blown cash flow mode. And since then, it's been the majority multifamily, but I've invested in mobile home parks and self-storage and car washes and ATM machines and, hard money lending. And I mean, the list goes on and on, publicly traded REITs, all that kind of stuff to generate enough passive income to actually live on. And so we were talking before the show, I was a lot like you. I was in a career of sorts, not a career that I personally enjoyed. I was in oil and gas working, 100-hour work weeks and stuff like that. But I had to find a way out of that. I had to find a way to make it, a work optional lifestyle, as we discussed. And so around 2016, 2017 is where that finally triggered in. And I finally had enough passive income to live on. And so from there, I went to go pursue things that I was actually passionate about, things that I was just self-interested in learning. I went to go work for one of the largest brokerage firms in the United States, got licensed because I wanted to learn stocks, bonds, and mutual funds so that I wasn't so biased towards real estate. I wanted to know the whole spectrum of possibilities. And that was a great learning experience, but ultimately, it led me right back into real estate full time. So been an investor with Ashcroft Capital and Joe Fairless for years and years. And I reached out to Joe to see if they could bring me on their team to do educational events, to speak on stage and to do podcasting and to do webinars and to do, property tours and just whatever, to travel around and get the word out about this stuff, because it's a really underserved niche, as you know, and there's just not a lot of people out there talking about this. I always joke that when you're driving down the highway, you see all the Fidelity and Schwab and brokerage house advertisements. You never see private placements. You never see, how much cash flow do you have? Here's an opportunity, right? So that's kind of my overarching mission, is to spread the awareness that people can do this, whether you're in the middle of a career, whether you want to leave your career, whether you want to switch to part-time work instead of full-time, whether you want to travel more. That's one of my wife and I's biggest passions, is international travel. So yeah, man, that's kind of how the story evolved.
Nice. So since you mentioned it, you went deep into mutual funds and kind of the Wall Street aspect of investing. What was it that turned you right back to real estate, and what's the distinction? Because most people, and I think most people that are not familiar with private placement investments, they've been taught their whole life, here's your mutual funds, and here's your IRA, as you said earlier, and they don't know about how to leverage these opportunities that have significant advantages from an investment standpoint. So what is it that turned you right back into real estate?
I think the biggest thing was a misalignment of interests. So the way that the system works is you've got people fresh out of college going into these brokerage houses, and then all of a sudden being the smartest person in the room, right? Telling everyone what they should do with their money without having any credentials themselves, without actually being investors themselves. And so I was being forced to tell people that, these mutual funds are the thing for you. Meanwhile, I'm not investing in them. I invest in real estate, so it just didn't sit well with me. And when you do a syndication, you've got a general partner usually investing their own capital alongside you. So if the ship is sinking, they're losing money too. And I feel a lot better about having that personal relationship, and that alignment of interest a lot more than just, you should do this, but I wouldn't do that myself. That's the biggest part. Other reasons would include the volatility that the public markets have. So some of these REITs, which is a real estate investment trust that's publicly traded, has a really high correlation to the broader stock market index. So in years like this year, where you've got the S&P 500, the Dow Jones, and the NASDAQ all 20, 30% down, that's pulled a lot of the REITs down for really no good reason other than just correlation, right? There's so many algorithms and high frequency trading and institutional buyers. When they go dump shares, they dump it all, And so I don't like the idea that I made a solid investment into actual real estate that's performing well, and yet my account is 20 or 30% down. That just doesn't make sense to me. So private real estate does not have hardly any correlation to the public stock market. The third reason is with a REIT, for example, you lose a ton of tax advantages that would otherwise be available to you if you were to do it privately, whether it meant, individually buying your own real estate or doing a private placement where you get depreciation that flows through to you, the limited partner. And so, kind of tallying up all of these things in addition to usually your yields are higher in the private sector than they would be with a publicly traded REIT or, say, a blue chip stock that pays a dividend out or something like that. And so just kind of running the analysis, pretty common sense, really, when you dive into it. It just makes a lot more sense for me anyway, someone who lives on, cash flow and passive income. I'm looking for stable, predictable circumstances, not the wild roller coaster. And I hope I bought at the right time. And I hope the Fed doesn't do this, or, someone comes on CNBC and says, sell everything. And all these people are watching that stuff and my account's going down. So those are a few reasons.
Well, Elon Musk makes a tweet.
Yeah. Exactly. That's the world that we live in today, is influencers, right? And celebrities. Everyone's got an opinion, and it matters, who's following them and who's listening. And it's just kind of crazy. There's so many people that are, whatever Warren Buffett comes out and says, they just go and mimic that, and whether he's right or wrong, whatever, but it's far less predictable. And, but I'll give some pros to the stock market. It's irrational, right? And so a lot of the time you're overpaying for things that otherwise you could have had more of a discount in the private sector. But there's also times where things get pulled down artificially when there was no real justification for that. So sometimes you can get in at a good basis and kind of ride the wave back up. But generally speaking, I like that monthly consistency. I don't like, these REITs sometimes will either stop or pause distributions, or they'll cut them in half because their share price went down, or whatever happens. It's just more of the Wild West out there.
Yeah. And in terms of the fee structure of mutual funds, I think most people are not aware that on a long time horizon, how much of their money goes to fees. And how was that for you? When you actually had to, when you were there, and people, and I always think that's funny what you said, that there is a misalignment. I remember sitting in front of some people at the bank, and you can tell they're selling you a product that they're being told by their bank.
Yeah.
Like, hey, this is what we got to push into the market because this is where we make the biggest cut.
Yeah. Well, back to, exactly to your point. So it's, here's the Wall Street methodology. Let's get as much assets under management as possible. Let's charge a 1 or 2% fee. And regardless of the performance of what we're selling, whether it goes up, down, sideways, doesn't matter, because we get our fee anyway. And so, the structure of a lot of syndications is they might have a preferred return. So the first, say, 7% of the deal or available cash flow is going to the investors before the general partners even get a cut or a share in the profit. So it's really based on whether or not the general partner can perform the business plan. And if they can't, they're not making any money. And so I like that a lot more than just, I don't really care what happens to your portfolio because I'm getting a 2% fee every year. And that to me is a big misalignment of interest.
Yeah, I mean, it says it all. If they don't put their money where their mouth is, and I think that's the beauty of real estate. Every single GP that we ever aligned our money with was heavily invested in the deals. But then I guess the question for someone who is coming newly into the space is, how can they identify those GPs, that have best practice and also that have a track record, or, where it's more likely that they can deliver sustainable cash flow?
Yeah, that's a great question. And I just made an episode on this on my podcast, Passive Investor Tips, which are just short segments that I dive into. And I said recently, in my opinion, if there was just one metric I could look at when I was doing my due diligence, if I could only choose one, it would be the track record of the team, because that tells the story the most. And so you have three risk points, generally speaking, in a syndication or a private placement. You have the operator, their track record and their ability to actually execute the business plan. You have the market that you're investing in, and markets are very important. And then you have the deal itself. How good is the deal? How conservative is the deal? What's the age of the deal? What's the potential of the deal? How many units can you rehab on the deal? What's the cash flow? All that kind of stuff. So if I had to put percentages to the importance of those three, I would say, personally, 50% is the operator and their ability to actually execute, and 25% is the market, and 25% is the deal itself. And I'm only saying that because of my personal experience of, for example, I did a deal in 2016, great property, great growing, expanding market, great, cost basis that we got. The whole thing was great. The operator could not execute the business plan. They got maybe 20% through, probably not even that. They hired the wrong contractors. They hired the wrong property managers. They had liability pop up. They were getting sued. It was just a nightmare. And they ended up selling the property early. It's supposed to be a 5-year business plan. They sold in like maybe a year and a half to get the investors out. And we ended up with maybe half or less of the projected return that we were all expecting or anticipating to get. And that's why, again, 50% came down to the operator in that situation.
Yeah. So then what is the difference between an exceptional operator and, as an LP, what should people look out for to make that distinction? And the thing is, you and me kind of probably had to learn it the hard way. We put the money with people that we eventually noticed they don't execute to the par that some of the other GPs that we put our money with operated.
Yeah. It's been a trial and error, and I think it always has to be, because you have to learn about yourself too. There's things that I failed to ask as part of my due diligence early on, simple things like, does this deal have a preferred return or not? Or are the distributions quarterly or monthly? There was things I skipped over that I realized after a while, those are actually really important to me. I really value that. Or how's the communication with the group? If I call, am I getting a voicemail every time and then a call back a week later? Or is someone picking up the phone? Do they have adequate staff and capability? Is this general partner, are they doing this part-time on the side? Or is this their full-time focus? All these things matter. So the approach I've taken in recent years is I start with myself first. I say, what are the goals that I'm trying to accomplish? And then I say, what kind of investment would be most appropriate to get me to those goals? And people have different goals. Sally over here has a goal of $10,000 a month passive income. John over here has a goal of $5 million net worth by the time he turns 60, right? Those are vastly different. And so John might be interested in doing new development projects that don't even produce any cash flow because he doesn't care. He's got a full-time career. He's a doctor. He doesn't need the cash flow. And then Sally over here is trying to leave her job. So what good is a new development deal that's going to take 5 years and not give her any kind of passive income? That's not going to be the right fit. So I try to find these middle of the road scenarios most of the time where I have a combination of potential equity upside, buy low, sell high, and cash flow in the meantime, in a value add business plan, which means that we're renovating and making the property newer, nicer, safer, that kind of stuff. And to me, and then to throw on top of all that, we have tax advantages and we're using leverage, and stuff like that, conservative leverage. So to me, that's kind of the catch-all. I mean, if there was a perfect investment out there, it would have all of those elements to it. There's some things I do just solely for cash flow that has a higher yield, but then there's no equity upside to it. And there's very few things I'll invest in that are just an equity play, but they don't produce cash flow. So those might be appropriate for certain things in my portfolio, but 80% is what we're talking about. It's value add real estate that encompasses those 4 categories.
Yeah. So lately, we're getting a lot of headlines, and you also mentioned leverage, and we've just seen one of probably the biggest leverage bubbles blow up with FTX.
Yeah.
People are scared right now. People don't know where to put their money. And there's also a bunch of headlines, that real estate is going for the dump. From speaking from the inside of, the industry, why are people like you and me still bullish on what we're doing?
Yeah, the thing about headlines is, one, they are catchy, they're intriguing, and there's a lot of headline readers these days that aren't even taking the time to dig into what the article's even saying, right? It's just, you just see the headline, oh, real estate's going in the dump. Okay, so that makes somebody think, I better not buy real estate then. Well, first of all, real estate is local, and also, what asset type are you even talking about, right? Because self-storage is not office. It's not medical facilities, right? Single-family homes, which a lot of people think of when they hear real estate, is not valued the same as multifamily apartments, meaning that a single-family home is usually they're looking at comps or comparable sales. And so as interest rates have come up and mortgage payments have gotten a lot higher, people are starting to discount the prices of a single family home for affordability reasons, right? And so if your neighbors are all price cutting, the value of your single family home is going down as well. And there's really nothing you can do about it. Even if you have a rental property and you've got a great tenant that's paying above market rents and has never been late for 10 years in a row, nobody cares, because if you go to sell that property, it's based on comps. Well, in multifamily and commercial real estate at large, your valuation's coming from the net operating income. And that's a lot different because there may not be a comparable property nearby. If you've got a 300 unit 1980s built property, in the surrounding area, it might be 2010 built luxury apartments. It might be 1950s old school vintage apartments. So there may not be anything to compare it to. So you've got to look at the net operating income. And what we're seeing right now is 40-year high inflation running from 7 to 9% annualized right now in the US. And that's helping justify rent bumps, okay, in addition to the value add business plan that we're implementing on top of that. And what that's doing is driving additional revenue to the net operating income. And so what happens is if we go to list our property for sale, somebody's looking at that number. For simple math, we'll say, and this would be a low number for a property that we do, but we'll say $1 million a year net operating income. Somebody pays a multiple for the income stream, just like in the stock market when you look at PE ratios, price to earnings. So somebody says, that's trading at a 20x multiple of the earnings. Same thing with multifamily. So somebody might say, hey, $1 million a year on that property, I'll pay you $20 million to buy that property. So when we can take a property that does $1 million a year and bump it to 1.5, we just added millions and millions of dollars to the valuation of that property through forced appreciation, through rent bumps, and through other revenue generating items like putting washers and dryers in the units if they never had that before, or having premium covered car parking, or profit split shares that we do with home security systems, with TV and internet providers, and things like that. We fence in ground level yards and we charge a premium for those particular units for people who have pets and stuff like that. So all of that is helping add to the income of the properties. And so it's a whole different ballgame. Yes, interest rates are hurting your potential sale price just like they are across the board in real estate, but there's more to the story when it comes to commercial real estate than talking about single family homes. And the last thing I'll mention is, again, real estate's local. I said that before. So Manhattan and San Francisco are not comparable to Orlando, Florida, or Dallas, Texas, right? You got to look at migration trends and where people and companies are relocating to, and it's just a whole different story. So those are the headlines I hate the most, is when somebody just generalizes and says real estate's going down the tubes, because is it? Because there's a lot of money being made. In fact, Q1 of this year was the highest transaction volume in decades for multifamily apartments. And I know we just sold just 9 properties to Goldman Sachs in conjunction with Blackstone. So there's a lot of big money entering this space, in addition to syndicators and private investors as well.
So why do you think there is big money moving in? And I mean, we've also seen them setting up funds with thousands of single family homes, and they're trying to grab a lot of the multifamily. Why are they moving here in the last couple of years? Why is smart money moving in?
Well, there's a lot of reasons for it, but one, yield is still relatively hard to find. There was a time in the US, at least, back in the 80s or late 70s, you could go put your money in a bank account and get paid 10% annualized. That was a real time in our history, but that doesn't exist anymore. You look at your traditional bonds and CDs, which are certificates of deposit, and annuities, and just money in the bank, money markets. I mean, they're all paying like 1, 2, 3, maybe 4%. So everyone's chasing yield. If someone can go buy a multifamily apartment and make a 5, 6, 7, 8% yield, that's incredible. That's almost double what other assets can provide. The other thing is, especially in commercial real estate, it's an inflation hedge. Since 2012, the total return of multifamily has been in excess of the government inflation by 583 basis points. That's 5.83% higher total return than what the inflation was since 2012. Now, that'll be interesting to see as the results come in here this year, because we have such high inflation. I don't know that it's going to be the same, 5.8%, but basically it outperforms inflation. And so as we're in inflationary times and recessionary times, this is something to consider. Fannie Mae and Freddie Mac in the United States hold a ton, and I mean a ton, of these mortgages. And if we go back to 2008, 9, and 10 during the Great Recession, they had less than a 1% default rate on those loans, which is incredible, because we all know what happened to single family homes. People lost homes left and right by the millions, but these loans had less than a 1% default. The other metric that I always think about for myself, I learned this through my mentors, by the way, who got me interested in this stuff in 2015. The average Class B multifamily rents dropped $125 per month during the worst of the Great Recession. That was the absolute bottoming out, worst scary time of that whole recession. Had a recovery in less than 2 years to all-time high rents again, because of the need that people had for affordable housing at that time. So when we're buying a property today, a multifamily apartment building, the rents are usually already $200 below the market value on day one. And it's a cash flowing asset right out of the gate. And so if we can even get halfway through a business plan, a value add business plan, we've got a cushion built in to withstand some volatility or even some rent cuts at that point, and we're still holding a solid asset, to make it through the next few years. And our debt terms are longer than our anticipated hold period. So if we think we're going to get in and out of a property in 3 years and be able to renovate it, we're going to put 5, 7, maybe even 10-year debt term on that property to give us flexibility on the back end if the market conditions aren't good to sell into in the next couple of years. Something to think about. That's a lot different than most single family.
And I think this is where we see a little bit of pressure on some of the operators. And now we're talking about the less exceptional GPs that might have not structured the debt correctly, given, the euphoric interest rates in the last couple of years where money was basically free. that are a little bit in the pickle now. And what's your take on that? Because we look at that as an opportunity for people, that are ready to go to buy more real estate.
Yeah, well, one thing to realize about commercial real estate is you're not getting these 30-year fixed rate loans like you're getting on single family homes. I mean, long-term debt on commercials, like 10 years. And a lot of these operators, to your point, I've never been a fan personally of bridge loans, which is a short-term loan to get you from A to B, get you a quick close or whatever, so you can kind of get in there, renovate and refinance. Well, this is not a good time to be refinancing. If you get a 5% loan and now you're refinancing at 8%, that's not going to work out for you. So anyone who's been doing bridge debt that's adjustable, especially not buying an interest rate cap, which limits your risk, to the upside there if the Fed decides to take rates really high up, or they don't have assumable loans. There's a lot of things you can do creatively on your debt structure, but they are in a pickle, and if you don't have adequate equity in the property, then you may be forced to sell, and perhaps forced to sell at a loss. And the other thing is that the deals that are transacting right now, a lot of them are expiring on their debt term. So maybe, 4 years ago, they got a 5-year debt term, and they locked in at like a 3% rate. Well, now, they got to make a choice. Are we going to go get a 7% loan at this point, or are we going to sell? And so some of the deals that we're buying right now are at like a 20 to 25% discount relative to pricing 1 year ago. And so to your point earlier, the Fed has just doubled interest rates, more than doubled them in 12 months, which is incredibly fast and incredibly hard. And nobody has the crystal ball, I don't think even the Fed, to know how high they're going to take these. And so I'm hoping that we're nearing the top, but it's an opportunity if you're a buyer today to get in. I believe there's a short window of time happening right now where you can pick up these properties at a discount, assuming that they're going to cash flow day one. And then either rates will start to, taper off and stagnate, or who knows, the Fed could end up tapering them back down if inflation starts coming back down again. That's an opportunity to then refinance in a few years, if that happens. I don't know. I don't have the crystal ball, but I don't think the Fed can take interest rates up to, 15% or something like that. That's going to implode the world economy. So we got to be nearing the top here pretty soon.
Well, they did say they want to break things. I don't think they want to implode the entire global economy, but they did say they want to break it.
And they may very well do that, in the short run. So we'll just have to see. There's a lot of factors there because the Fed's really caught between a rock and a hard place. Their goal, obviously, is to bring inflation down. And I get that, right? I think everybody kind of understands why they would do that. At the same time, we're heading into recession. Their other objective is to help out the economy when we go into recession. And so that usually means cutting interest rates like we saw during the beginning of the pandemic, or, what they started doing previous to that. So I don't know, man. I don't know how it's going to all pan out, but make sure that your debt is properly structured for sure if you're going to be investing right now. This is a very volatile time.
Yeah. But what's going on with the Fed, for me, is just another reason for people to get in charge of their personal finances. Because what I've seen probably over centuries now is that it's always the people who are not in charge of their own finances who get hurt the most. Like, if you're relying on your monthly paychecks or weekly paychecks, you will be hurt the most because you might be on the shorter end of a recession. People that, have money and have resources, they can usually get through those tough times. And that's one of the reasons I think that it's so crucial that the general public gets into investments where, they can grow substantial wealth for their family and build that financial fortress around themselves, be financially literate and educated so they don't get hurt in those times, because right now it's happening again, and it's always the people that are already in a tougher spot that get hurt the most.
Yep. Yeah, well, again, back to the traditional system, what good, if you have one income source and it's from a W-2 job that you work, and then you have your only real investments are in your IRA or your 401k, well, first of all, you're trapped. What are you going to do? You can't pull the money out without paying heavy tax and heavy penalty, right? You're just supposed to leave it in and invest for the long haul. So that's not helping you in terms of cash flow. And if you lose your job, you basically lose everything. So the quote from Warren Buffett, never rely on a single income source, make investments to create a second source. I take that a step further and say, create many different sources of income. I've probably got 50 plus different passive income sources. So this investment can go down and this sector can get hit and I can lose my job and I can, but I have all these backstops surrounding me, and it's not a foolproof plan. Nothing ever is, but I always tell people, why not start the passive income game now? Don't wait till you're 70 to say, okay, now I'm ready to start learning passive income, right? I got $2 million. What do I do with it? That's not a good strategy. And so it can never hurt, even if you have $1,000 a month coming in passive income. That may not be enough for you to leave your career, but at least it could help pay some bills in the meantime and help you supplement, hard times. If you did get laid off or you did have to make some career pivot or take a pay cut or something like that. So I think it's a joke that most of these employers give pay raises of like 3% annualized. First of all, inflation's like 7, 8, and 9, number one, but why be reliant on someone else to decide your pay raises like that, assuming you even get them every year at that amount? A lot of people don't. But when I look at my passive income portfolio and I tag that into the mix, I'm getting like a 10 to 12% annualized pay raise every single year, just because I have investments that keep compounding and growing and building. And every time I get passive income every month, that starts to build up. And then I go make another investment. And now I got another $250 a month coming in from that one. And it's a snowball effect. It takes time. I always say to me anyway, it's simple, but it's not easy. It takes self-discipline and it takes sticking with it for the long haul. But it's so worth it, you guys. My whole journey in the beginning, starting from scratch, took about 7 years of really applying myself and really educating myself and really, saving and being diligent to create enough passive income sources to end up being able to live on. And that's not going to be everybody's situation, but this is an important distinguisher for people to think about. You've got rich and you have wealthy. And these are not the same things, right? Rich is all about your income, right? Someone making $500K a year plus is considered rich by numerous different sources. I've never envied being rich because we all know the lottery winners and the celebrities and the professional athletes that make millions and go broke, right? It's here today, it's gone tomorrow. They don't know how to manage their money. I don't envy that. I never want to be a high income earner to that point anyway, because you pay half of that or more in tax. But wealthy is about passive income. It's about having enough assets to pay you every month, whether or not you work. And so if somebody lived on, let's say $70,000 USD per year, okay, and they had $1 million invested and they were getting 10% a year on their yield, just for a simple math example, that's $100,000 per year in passive income, $70,000 that they need. They, in my opinion, are wealthy. Okay, but the professional athlete that just signed a contract for $10 million is rich, but not wealthy. They're not wealthy until they have enough assets to cover their living expenses. That's a big thing to understand.
Yeah. And I think that's a very crucial thing. And most ball players, they don't make big bucks. It's really just like once you're in like the top couple percentiles of the leagues that you actually make that money. And then a larger chunk of those lose the money because they don't have the understanding, the financial education on what to do with it. And
Correct.
I think the same is true, as you said, in other job groups. And I think one of the job groups, like our industry, the private staff industry, where I originally came from, is there's a lot of 6 figures income earners, you know, whether it's the private pilots or the butlers, the drivers, the chefs, the nannies. And they do have the incomes. But one of the things I see happening over and over again, they're getting accustomed to the lifestyle of the people that they're serving. And they're trying to buy similar watches, trying to buy similar clothing, shoes, whatever it is. And the money, despite being very well off, and that's where the discipline part that you mentioned comes in, you know, and really having that long-term approach is, I think that's where people, they think there's so much time and they can maybe earn the money less or save the money later. I mean, but the compounding aspect and giving it sufficient time is so powerful. And as you said, you yourself, you were able to kind of get free and make work optional within 7 years. If anything, that would get me super excited. Like if someone tells me, who's your age, you know, that within 7 years of being disciplined and diligent, you could make work optional. I think that's super exciting. And then, you know, when what you said earlier about someone in his 70s having 2 million, then learning how to invest. If you do it early, you will probably have significantly more than just 2 million when you're 70. And having worked a lot less.
And you'll have the system built. You'll have the mindset. You'll have the philosophy. You'll have diversification. I mean, you'll know how to pivot. You'll say, hey, you know, multifamily doesn't make sense anymore. I'm going to pivot over here to self-storage, you know, or whatever, instead of trying to learn it all from scratch and then being screwed if it quits working on you, you know. And it's so much easier to adapt and to pivot when you're younger than to try to learn something new at 70 and take all your eggs and all your basket and go to, you know, do something like that. So there's a great quote to your point. I love what you said about, we call it, you know, keeping up with the Joneses or lifestyle creep. You know, most people, when they get a bonus of $20,000 a year, they go buy a new car and they upgrade their house and they go spend it, you know, and now they're driving the BMW and then they get another pay raise and then they get a vacation home, you know, and so it's just liability after liability after liability. And then if you lose your job, you might lose everything, right? And so that's a common theme. And so there's a quote, it's an old Stoic quote, actually, from over 2,000 years ago. I forget if it was Marcus Aurelius or Seneca or who said this, but it said, you can be twice as rich by desiring half as much. And something that my grandfather told me when I was probably 18, he said, invest first and buy luxury second. And that was such good advice, because I think back, if I would have just gone out as soon as I got a job and bought the luxury car and bought the big house, I never could have started investing. And those things would have eaten me alive, you know. And so I just posted a podcast a couple of weeks ago of how we bought a Porsche car using an investment. We took our money, made an investment, a passive investment. When it sold, we took just the gain portion and bought this car all cash and then reinvested our original principal back into another deal. So my net worth never went down, and I got the luxury car the way I see it, basically for free. So really cool things that you can do, but not if you're going to be on that other track of trying to keep up with others and trying to impress people that don't really care about you.
Yeah, and that's often it, right? It's you know, it's a flex for people you don't even care about, and that's even worse. And maybe that realization dawns at some point later in age.
Yeah. Learn it fast.
Yeah. So on a personal note, one of the questions I always like to ask is, what do you consider a life well lived for yourself?
Yeah, that's a great question. So I think it's just what your overarching mission is, you know, and there was a time in my life that I worked so much that that was my life. My life was just work. It was get up super early, 3 a.m, go to work till it's dark, go home, eat, take a shower, wake up, go back to work. I didn't have time for relationships. I lost a lot of friendships. I didn't have time to date. I didn't have time to travel. I didn't have time to unwind and do things that brought fulfillment to me. I couldn't really give back in any other way but financially. And, freeing up my time allowed me to give my time back to others, to teach other people for free. I don't have any upsells here. I don't do coaching programs or books or anything like that. I just do 15-minute calls with people all week, all year long. I'll talk to everybody and anybody, accredited, non-accredited, 18 years old, 70 years old. If you want to learn more about passive investing, I think it's critical. I think it's critical, quite frankly, for everybody to have some fundamental understanding of this stuff. And so, I look at it now. We had our firstborn about 11 months ago. So it's being a father, it's being a husband, and it's what am I trying to do to elevate other people? Because, after a while, it stops being about you so much, at least in my story anyway. Yeah.
Actually, I've heard that multiple times, that after some time, once you get to the point where everything is, or work is optional and those things, and then the fulfillment really seems to come when you make it about other people. And, you can only lay at the beach for so long, and you can only drive circles in nice cars for so long, and eventually I've seen that over and over in conversations. So I think that's a good place to start for everybody, to also make it about other people and have a vision that includes other people in their life.
When you see a lot of the examples of people who hit financial abundance, and I'll go through this real quick for your audience. If you imagine a triangle kind of upside down, like the food pyramid or whatever, but upside down. So the first level of wealth is self-sufficiency. That's where you maybe have an active job and you're paycheck to paycheck, but you're self-sufficient. You don't need supplements from anyone else. You can at least pay your own bills. Stability is the next hierarchy up. And when you're stable, you're not just paycheck to paycheck, but you probably have 6 to 12 months of savings in the bank account and a little bit more of a financial cushion. And so, it's just a little more stable. Then you get into flexibility, where if you wanted to, you could take 6 months off of work, or you could travel a little more. You could pivot careers, right? You have a more flexible, adaptable lifestyle. The step above that is what I teach people, and it's financial independence, and it's where you can fully live off of passive income from your investments, 100% covering your lifestyle costs. It's at this point that people, in my experience in network, start getting more charitable and start giving back a lot more. And the step above it is what I call financial abundance. And these are your people like Elon Musk and Mark Zuckerberg and, Warren Buffett, people with they literally can't spend the money they have. They just can't. It's just too much money. And so they end up giving a ton of it to charities or to solve world poverty, or what Bill Gates is working on with their foundation, the Bill and Melinda Gates Foundation. They're trying to eradicate disease and that kind of stuff. So I think that's if you look at the old, who was it, like the Rockefellers and all kind of the founding entrepreneurs in America, they were in a race to the top to make the most money and have monopolies, basically. And then at the end of their lives, they were kind of in a race to who could give the most money away, who was more charitable, right? So it was still a game and it was still a competition, but a lot of them just gave so much of their wealth away. And I think that's the beautiful thing. It's hard for me to see people who are literally paycheck to paycheck being overly charitable, like giving money they really can't give away. Like, you kind of do have to help yourself first, which sounds selfish, but you have to get to a point that you have a little bit of abundance that you can afford to give money away in a very meaningful way, not $2 to the panhandler on the side of the road, but to go give $25,000 away to a charity or something like that. And it's not going to make a dent in your bottom line or your living standard or something like that. So just my opinion, but that's how I kind of see that hierarchy of wealth.
Yeah, I totally agree with what you said about, there's very, very generous people with very, very little resources. And that sometimes is like heart-wrenching because, at the same time, they have the heart in the right place, but they cannot meaningfully back it up to truly make a difference, maybe beyond bringing their own time to volunteering or something. But it's just in terms of funds, even volunteer organizations need real money. Like to move the needle on anything in the world, it needs either a lot of time commitment from people, but definitely needs a lot of resources. And I think that's one of the beautiful things is that you can become charitable. And that's, to me, when I understood that I can be as well intended as I want to be, but if I don't have the resources, I'm not going to move the needle for anybody else. That alone was reason enough to start educating myself.
100%. Couldn't agree more.
Yeah. Well, Travis, this was amazing. Thank you so much for making the time. You did mention you're willing to talk to everybody. Where can people connect with you? If they either want to check out your podcast or maybe personally get in touch with you, what are the best sources? And we will also make sure to add those to the show notes.
Sure. Yeah. So the podcast is called Passive Investor Tips, and it's under Joe Fairless's podcast, the Best Ever Real Estate Investing Advice podcast. So you can just go bestevercre.com and click on Passive Investor Tips there. It's also on a YouTube show. I do it on video. If you want to jump on my calendar, you can go to ashcroftcapital.com/Travis, and that's my direct calendar link. So no upsells. Don't even have to talk Ashcroft stuff, but that's just where I put it for everybody. You can reach out on LinkedIn. You can reach out on Bigger Pockets. My name's Travis Watts, WATTS. And you can search at Passive Investor Tips on Instagram and Facebook, and we can connect there. So anything I can do to be a resource for any of you, I'd be happy to do it. So thanks for connecting ahead of time.
Why are you so passionate about giving your own time? And I want to thank you for it because you've also been very generous with me, and that we're having this conversation. But what is it in the hearts of hearts for you that encourages you to spend so much of your personal time educating people on private placement investments?
I think, to be honest with you, I've always done this, not financial education, but when I was a senior in high school, I wrote a 60-page book, and it wasn't a school project. No one told me to do it. I didn't have to do it, but I called it How to Achieve a 4.0 GPA in High School with Minimal Effort. And the reason I wrote it is because I went to kind of a bad school. It was like a C- rating school, and I saw a lot of people struggle academically, and there were little strategies and tips and tricks that I was doing to make things easier, I thought, academically. And I just wanted to share that with people, so that came from an early age. I mean, I've spoke on podcasts about different benefits of health stuff and drinking celery juice and other things. So anything that has created a real result in my life, I just want to be open to sharing it. And the second thing that really prompted me that direction was when I was first looking for mentors in this passive investing space. At least living in the United States, being, so capitalistic, everybody was just trying to sell me something, right? No one was just willing to open up and say, hey, man, I'll take you under my wing and try to be a mentor for you. Everyone was saying, buy my book, buy my course, buy my program, buy my product, or pay me $300 an hour to be your coach or whatever it was. And I thought that I was just very discouraged by that no one was actually willing to just help out in small increments. I wouldn't expect someone to really, be a full-time mentor for free, but just 15 minutes, can I just, talk to you as a human being? And so that's what I decided I was going to do is my mentors were not public facing figures. They wanted to remain kind of behind the scenes and unknown, rightfully so, I suppose. But I wanted to be the front-facing guy to say, reach out to me and I'll help you in any way I can.
Awesome. I appreciate that so much. It's amazing to have people because I think for some people it's discouraging. They don't have access to mentors. They can't afford those quite expensive mentorship programs that are out there to get started. So, it's very encouraging to have someone like yourself putting in the time and putting out the content so that people can get started on their journey. So, yeah, thank you so much for doing it.
Well, you bet. You bet. Thank you.
Thank you for joining us at The Path to Wealth. We hope you enjoyed today's episode. Check out our upcoming guests and be sure to share it with all your friends and family that want to take their life to the next level of wealth.